Hey there, fellow traders. Are you ready to unlock the secret to jaw-dropping profits? Buckle up, because today, we're about to reveal an insanely accurate trading strategy that's been our little secret weapon. Just look at these successful trade signals given by this strategy on Bitcoin. This is truly unbelievable. In this video, we will introduce our game-changing combination of TradingView indicators that'll have your account exploding with winning trades. This strategy is so simple, yet so powerful, it works every single time. So, don't waste another minute, hit that subscribe button, smash the like, and let's get ready to make some serious money. Okay, so how do we build this indicator setup? First, head over to TradingView and open the chart of any market with high volume. As an example, we will select Bitcoin on the 3-minute chart. We will also show you how this strategy works on longer timeframes, so stay tuned for that. The next step is to open the Indicators tab and search for Limited Fisher Transform. Select this indicator created by Fatero. The Limited Fisher Transform is a technical trading indicator that helps traders identify potential price reversals and determine the strength of a trend in financial markets. It does this by transforming price data into a Gaussian probability distribution, making it easier to spot turning points in overbought or oversold conditions. This indicator is based on the premise that price movements are not normally distributed, and by converting them to a Gaussian distribution, it enhances the identification of extreme price movements and potential reversals. The Limited Fisher Transform oscillates around the zero line, with extreme values above and below it, indicating overbought and oversold conditions, respectively. A positive Fisher transform value suggests that the current trend is bullish, while a negative value indicates a bearish trend. A cross between the lines in the oversold or overbought areas produces buy and sell signals. If we look at the quality of some of them, we can see that they're very accurate. Obviously, this doesn't mean that we should use this indicator alone. This would be a huge mistake. This is because the indicator might work well in a range market, but as soon as the security starts trending, the accuracy of the signals decreases. So to eliminate these fake signals, we need to add the second indicator to the chart. This tool is called Supertrend MTF-ASCII. It was developed by Lonesome the Blue. Before we can use it, we need to change its settings. So open the inputs and change the ATR factor to 2.5. Then head over to the Style section and uncheck Supertrend. Acting as dynamic support and resistance, the Supertrend line often serves as a reversal point for price movements, providing valuable entry and exit signals for traders. Before diving into the strategy, it's essential to understand the Supertrend indicator. It's a trend-following tool that combines moving averages and the average true range to create dynamic trailing stop-loss levels. The primary goal of the Supertrend indicator is to help traders identify market trend direction and generate precise entry and exit signals based on price volatility. This trading strategy capitalizes on the Supertrend indicator's ability to act as dynamic support and resistance. When the price approaches the Supertrend line, it often reverses, providing a high probability trading opportunity. Here's how to implement the pullback to Supertrend trading strategy. First, determine the overall market trend using the Supertrend indicator. When the price is above the Supertrend line, the market is in an uptrend. Conversely, when the price is below the line, the market is in a downtrend. In an uptrend, wait for the price to pull back towards the Supertrend line. In a downtrend, wait for a rally towards the Supertrend line. The proximity to the Supertrend line increases the likelihood of a reversal, making this an ideal entry point. Once the trend has been identified, confirm the reversal. Use additional technical indicators or price action analysis to confirm the reversal at the Supertrend line. In our case, we will use the Limited Fisher Transform. Once the reversal is confirmed and a buy signal is issued, enter the trade in the direction of the trend. For an uptrend, buy when the price bounces off the Supertrend line. In a downtrend, sell when the price reverses from the super trend line. Remember, do not enter the trade as price did not respect the super trend line. If price exceeds it, the setup is invalid. Next step is to set stop loss and take profit levels. To manage risk, set a stop loss order slightly beyond the super trend line. This allows for some price fluctuation while protecting your capital if the trade goes against you. Set a take profit level based on your preferred risk-reward ratio or use a trailing stop to lock in profits as the trend continues. Traders, we hope you like this trading strategy. If you do, then please leave a like to this video and share it with your friends. Now let's take a look at some more examples so that you fully understand this secret method. In this example, the market is in a downtrend. This is confirmed by the super trend. A retest of the line is then seen without the price exceeding it, which is exactly what we want. Finally, the oscillator issued a sell signal. We open a position at the close of the price bar. The stop loss is set above the super trend line. We target 2 times the risk. Now let's take a look at how this strategy works on longer time frames. We're currently looking at the 1-hour chart. You may notice that the oscillator only shows the last 5 or 6 signals, but this doesn't matter. By looking at the crosses in overbought and oversold areas, we can still spot the entry. As we can see, the strategy finds perfect entries. It works on all time frames and all markets with high liquidity. But remember, you should stay disciplined when trading with any strategy we present to you on this channel. Discipline is a critical aspect of successful trading, as it helps you navigate unpredictable and often volatile market conditions. A disciplined approach to trading ensures that you consistently apply your strategy, which is crucial for long-term success. Consistency helps you avoid the emotional pitfalls of fear and greed, which can lead to hasty decision-making and poor risk management. By following your strategy and trading rules, you can minimize emotional interference and focus on making objective, data-driven decisions. Discipline plays a significant role in risk management, as it helps you adhere to predetermined stop-loss levels, position sizing, and risk-reward ratios. Traders who lack discipline often make impulsive decisions, such as moving stop-loss levels or over-leveraging their positions, which can lead to substantial losses. By maintaining a disciplined approach, you can protect your trading capital and reduce the likelihood of substantial drawdowns. Traders, we hope this strategy will make you big profits. Thanks for watching this video and see you soon.